Equity Bank customers using online payment service PayPal will now be able to withdraw their funds from their PayPal account within 3 business days thanks to the improvement and streamlining of the platform. Equity Bank can now process its customers' withdrawals transactions within 3 business days, down from the previous 8 business days. This enhanced service offering from PayPal and Equity Bank is expected to help nurture the immense opportunities for cross-border commerce offered to Kenyan merchants who trade online. PayPal allows Kenyans to make payments and receive money locally and internationally without sharing their financial information with the sellers. Now, with the improved withdrawal service, Equity Bank customers using PayPal can withdraw funds within a shorter processing period. Some good news there for the customers for the bank. And keeping with some good news, you may pay cheaper rates in case you're using Pewin cabs after it unveiled a taxi app that will be going towards streamlining its operations and ensuring customers are able to pay flexible rates. The new move is expected to stiffen competition in the taxi business following the entry of Uber and Safaricom's Little Pay Cab, which continues to attract uproar in the market from a position of better revenues.
So for ourselves, we tell our customer that we'll give you predictability in pricing. You'll get pricing before even the trip begins. Secondly, customers want choice. What if you have a group of more than 4 passengers? How do you get to where you're going? Or what if you're going to the airport and you have lots of luggage? How can you be able to get a larger vehicle? So we give you this choice within the application.
Indeed, some good news there, of course, for taxi users. A lot of marketing campaigns coming through for the taxi apps. Let's see how that pans out in the coming days now that you're seeing more of Kenyans opting to go the taxiway, where we've seen the rates drop to as low as 300 shillings, depending on the distance you intend to cover. Well, still keeping it with matters technology, the central bank did push for banks to live by the expectation following the enactment of the Banking Amendment Act 2015, which aims to ensure that banks cap the interest rates at 14%. Whereas this conversation continues, a lot of expectations are expected, especially from the mobile phone loans, which are yet to know the fate in terms of will they be applicable to the new rates or not.
That's a lot.
The thorny issue being whether the rate cap law applies to mobile money loans. CBA Bank's M-SHWARI and KCB M-Pesa, both products run by Safaricom, for instance, charge a one-off facilitation fee of a maximum of 7.5% on microloans to be cleared in a specified period of time, in this case, 1 month. Central Bank Governor Dr. Patrick Njoroge says the regulator is treating that as an emerging concern arising from the fact that the rate capping law does not exactly specify how mobile transactions should be regulated.
We communicated on these questions before the law came into effect.
The interest rate capping law in its current form has no clause that specifically defines how mobile money loans can or should be capped.
Our view is we need to provide more information to the customers so that they are fully armed, so they can sort of go head-to-head with the banks. And yes, there is the element, I have said this before, of voting with your feet. So your bank is providing you with particular services or fees or whatever else it is, and in a term that maybe some of you find interesting, they are giving you a lot of kizungu mingi.
M-SHWARI alone has over 15 million customers, with over 70,000 transactions per day, showing the importance of the facility to financial access for the masses.
Well, now joining us from our City Centre studios to help us dissect this hot matter is George Bodo, who is the head of research at EcoBank. Good afternoon, George, if you can hear me. What do you make of the recent developments around mobile phone-based loans?
Good afternoon. I think the debate around mobile phone loans is warranted and warranted to me. And I say this for a number of reasons. The first reason is that the way mobile phone loans are designed, they're not designed for interest rate the way they are, the way we know interest rate on an annual basis. Number two is that the volumes that we talk about on the mobile phone loan platforms, especially compared to, if you compare to the current outstanding stock of loans in the mainstream banking sector, I don't think that it warrants this level of heated debate.
And perhaps, George, focus has shifted to whether or not mobile-based loans are subject to the new interest rate that was actually pushed and passed in Parliament. Does this apply to the mobile phone-based loans as well?
It doesn't apply. The law is not clear. The Act is not very clear whether it applies to loans advanced on the mobile phone platforms. But this is what I'm saying, in my view, that it's the interview, the debate around it, to me, it's a bit unwarranted.
But perhaps many would want to know, looking at the application of the law, there's the spirit of the law and the letter of the law. Perhaps majority of the consumers, their understanding is that the new capping of interest rates applies to all forms of loans. Perhaps what's your explanation as to why these loans will not be applicable in the sense that this new law stipulates?
If I get it correctly, my view is that there was a deliberate effort to exempt these guys from this law, especially from the parliamentarians, the authors of this law. And as I said in the beginning, I think the volumes, in my view, don't warrant a significant attention to these platforms. And also, if I look at the mobile platform, it's an alternative channel. For me, it's an alternative channel. The way they package these products is that it's very, very short-term loans, and you can't apply an interest rate on an annual basis on a 30-day loan. I think you're better off charging a one-off interest fee on this product rather than looking at them on an annual basis. And two, I think on the back end, between the two providers, the telco and the banks, the way they've looked at this thing, it's a volume game. There's a certain level of threshold that if they don't meet, then makes these platforms very unprofitable. So I think applying the law, the Act as it is on the mobile phones, in my view, will kill off these products. And I think this is something that needs to be very, very much supported because it's driving inclusion. I think the discussion should be at the central bank level, at the regulatory level, and look at it as a product and say, can we look into capping some of these fees charged on this as a product, but not engraving the charging model on the national laws. For me, I just don't see the sense in it.
It's there, George. And just before I let you go, perhaps you're a long-time banker, and observers in the banking sector say that if this was to happen, perhaps what would be the impact to the market? Would we see some of these banks that are offering mobile phone-based loans perhaps reconsider and pull out these products from the market?
Yes, definitely, they will kill the product. If you actually say that today, on a monthly basis, you're charging 1% or below, or 1.5% a fee, on interest rate, depending on how you look at it, on some of these loans, it will make them extremely unprofitable. And the providers, both the telcos and the banks involved in the arrangements, they will kill it off. They will kill it off totally, in my view.
And last one, George. So if this was to happen, what would it take at the point of regulation as well as Parliament as well?
I think maybe this is not something that should be taken to the Parliament for regulation. I think it's a product, as I said, for me, mobile phone loans, it's a product. Should be looked at it from that point of view. Central bank can send out a guideline to banks, say, please don't cap the fees you charge on these products at a certain level. They can issue that micro regulation at the level, and that effectively would end the debate. But I don't think that they should take it to Parliament again for review. In my view, it shouldn't. This is an innovation that actually, in my view, it's in initial stages. I think it needs to be given some time to incubate. As to whether it could be subject to regulation, it shouldn't come at this point as of now. I think it should be given some more time. And look at it, it's only 2 banks that are providing this, have plugged into this platform. It's only CBA that are plugged into this platform. It's only CBA, KCB are plugged into the platform. Equity Bank is running its own platform. And I think it should be given time.
Right. Well, perfect place to end the conversation. Many thanks there, George Bodo, who is the head of research at EcoBank, which is actually a firm that, a banking institution that has its headquarters in Nigeria.